Much of the market gains this year have been concentrated in the biggest tech names: Amazon, Netflix, Microsoft. So what does that mean for the second half of this year? Let's bring in Jason Ware, Chief Investment Officer at the Albion Financial Group, and Kim Forrest, Vice President and Senior Portfolio Manager with Pitt Capital. Let's point out at the start, Jason, that you own Facebook, Apple, Amazon, Microsoft, and Google. Kim, it's not that you don't like tech, but you prefer some others in the group: Microsoft, Intel, Texas Instruments, I guess it's Xilinx, and several others. But Jason, let me come back to the predicating part of this, and that is the narrowness, the percentage of gains that 4 or 5 stocks account for in both the S&P 500's gains and the NASDAQ's gains this year. Isn't that often the case, that a very small number of stocks drive the market?
Yes, it is often the case. If you look back at the last 20 years or so of data, what we see is that oftentimes about 4% of the stocks in the S&P 500 account for about 70% of any year's annual gains. So to look at that,
so 4%
look at the market
account for 70% of the gains.
Correct. Yes. That's what the data bears out. So looking at what we're seeing now in the market, I think one could infer, if you are to infer anything from market breadth, is that this is not something to be terribly worried about.
How about you, Kim? Do you see that this is obviously Facebook, Apple, Amazon, Microsoft, Google? That's not 4%, but this quintet of stocks, and if you throw in Netflix, is responsible for something like 71% or 90% of the gains. Does that worry you? And then why are you not in those but are in others?
Right. Well, it doesn't necessarily worry me because we've, again, seen this before. But the thing is, when I'm buying stocks, I'm looking forward in time. I'm a value investor. I don't necessarily have to own today's hot stocks. So what am I looking at? I'm looking at rising wages, and I think that's going to drive companies to finally invest in technology that's going to make them more productive. I don't know what the software is, but I know it's going to be delivered on semiconductors, and it's probably going to need the internet. So your telecoms are going to benefit as well. So those are the areas that I'm looking at to invest for the next 3 to 5 years. So that's kind of my answer is, yeah, these are hot today, but how about tomorrow?
Okay, so Jason, before I buy a stock, back when I could buy a stock, I wanted to know what makes it goes up, but I also want to know what makes it go down. What's going to make these giants go down at some point, do you think?
That would be more sellers and less buyers, right? So the key
Thank
question
you. That's
there
my
is,
line.
Oh, yeah.
You're the analyst.
Yeah. They pay you for that.
Come on.
Right, that's hot stuff right there, hot take. So no, I mean, so the big question is what's going to create an environment where people want to own less of these? And in our view, right now, we don't see anything that shapes out that will suggest that that's going to happen. I mean, when we think about these companies in FANG, we think about them being at kind of the intersection of the consumer and technology. These are names that people understand. They're names you know. Most people understand and are connecting on Facebook properties. They're buying from Amazon. They're streaming with Netflix, and they're searching with Google. And they're doing all of this on an Apple device or a Microsoft-powered device. So these are fundamentals that people get and they understand why there's growth and why they matter. So they continue to buy the names.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.